Are you confused about liquid on demand versus trading at a premium? Open-end funds mint new shares daily, giving you flexibility. Meanwhile, closed-end funds ride the market's ups and downs, impacting your returns. Want to know which structure fits your investment strategy? Watch the full video to get the insights you need.
Moving forward, Gary, to wrap up this week's version of the 5 things, we're going to talk our educational topic every week. We try and introduce new investing topics for our audience. This week, we're talking about open-end versus closed-end funds. Gary, I want to start with a couple definitions of each of those. So Gary, let's start with open-end. What is an open-end fund?
All right, an open-end fund is just a mutual fund or exchange-traded fund, an ETF, that issues new shares when investors buy and repurchases shares when investors sell. So what that means is that the share count fluctuates with the size of the fund. The pricing is determined once daily by the net asset value, which is just the fund's assets minus its liabilities divided by the outstanding shares, right? So imagine this for a minute. Let's say you have, a fund that owns the S&P 500. And you say, okay, well, here is $1,000, and the fund will say, okay, we're going to take your $1,000. We will go buy $1,000 worth of S&P 500 stocks. And then we're going to increase the share count of the fund. So the net asset value of the fund remains the same, right? The fund grows, but the share count grows by the same proportion. The net asset value is unchanged. They've grown the fund. They have your money. You own the shares. Now, let's say you want to redeem the shares. You say, hey guys, I want my money back. Hopefully you've made money. Great. So what they do is it's the exact reverse. They go and they sell those positions. You get the cash, and then they reduce the share count by the same amount. Again, the net asset value is unchanged. The share count comes down by the same proportion as the size of the fund did. So all this means is that people buy and sell shares. The net asset value doesn't change because you buy or sell, and the size of the fund can increase or decrease. That's why it's open-ended. You can have a larger or smaller fund with an open-ended fund.
Very good. Gary, moving on, closed-end funds. Give us the definition and more information about closed-end funds.
All right, so a closed-end fund is just like an open-ended fund with one major difference. That fund issues a fixed number of shares during an IPO, that stands for initial public offering. After the IPO, investors can buy and sell shares on an exchange just like the regular stocks. Those shares trade on the open market and have varying prices throughout the day. So shares in this situation will not be bought back on demand. The price will move due to changes in demand. And as a result of that, and because these prices can change throughout the day, depending on demand, closed-end funds will often trade above or below NAV, stands for net asset value. So where an open-ended fund is always going to trade right around net asset value, a closed-end fund, because it doesn't change the number of shares outstanding, it doesn't change the size of the fund, these funds can trade at a premium or a discount to NAV.
Very interesting. Gary, in terms of preference, right? As an investor, do investors prefer one way or the other, or why might they prefer an open end or a closed end fund?
So the advantage of an open-ended fund is that fund is almost always going to trade right around NAV. You're getting true pricing, again, because the fund can grow and shrink. With a closed-end fund, the big advantage to that is that fund isn't going to grow. And it really matters in terms of, say, niche particular strategies where, like say it's a microcap strategy. You really don't want to be in a situation where that fund can grow to billions of dollars because they won't be able to buy positions. So one of the big advantages of a closed-end fund is you limit the size because not all strategies have an unlimited capacity. The other thing to be aware of is that closed-end funds will often use leverage. And so they can take on debt as a way of growing. You have to be aware of that. There are risks involved. There are expenses involved with that. Now, there are ways that you can take advantage of all kinds of quirks and things like that. And we've done that at Deep Knowledge Investing. So the most famous recent example of a fund trading at a large premium and then a discount to NAV was GBTC. That's the Grayscale Bitcoin Trust. Now, at the time, remember, we've only had Bitcoin ETFs for just over a year. Now, at Deep Knowledge Investing, we do think Bitcoin is a great thing to own. It's my largest position personally. And I'm a big believer in the old saw, right? Not your keys,
Mm-hmm.
not your coins.
Right,
We
right.
recommend that people own your own Bitcoin. You should self custody. If that's difficult or confusing or scary, I totally understand. At Deep Knowledge Investing, we have written a guide to doing it. And literally, I have annotated this red arrows, push this button, fill out this thing.
Right.
We have made it as simple as possible. So you can self custody if you want to. There's no need to be afraid of it. You just go through the steps and we can help you with that. But just,
Gary, real quick, yeah, before you get into
yeah,
I know we're going to talk this Grayscale Bitcoin Trust story, but I did want to highlight for our listeners too that I think this is a really good example of the value and the premium that DKI brings to its subscribers. This is obviously one instance that we're discussing. I believe, Gary, this trade has closed out at this point in time, but I did just want to highlight that, right? I think this is a lot of the value, the way that you're thinking, the way you're researching the market, determining what recommendations to make to subscribers. So I just wanted to highlight that first, but then before you tell the story, Gary, but yeah, what did DKI see in Grayscale Bitcoin Trust that's different that no one else, maybe I'm sure others saw, right? But you were able to
yeah.
identify it. And then if you could just explain why that's such critical value to your subscribers as well, Gary, as you tell the
Well,
story. But I wanted to make sure to highlight that.
sure. Thanks, Charlie. And in fairness, we did make a ton of money in this and for our subscribers, and we were thrilled to do it. I was not the only person who saw
Right.
this. People
Yep.
did track this. But what happened was, if we go back to like 2020, 2021, something like that, the Grayscale Bitcoin Trust was the only way to get pure play exposure to Bitcoin that investors could buy in a traditional brokerage account. The only other way to do it was you had to go buy Bitcoin and self custody it. And as we talked about, that scares some people. So the fund traded at a huge premium because people who wanted that exposure, if you want to put it in a traditional brokerage account back 5 years ago, that was how you had to do it. So the fund traded at a big premium to NAV. And, I didn't do that. I went and actually bought Bitcoin itself. Now, later, when Bitcoin demand temporarily faded, because it was a closed-end fund, a trust, the fund wasn't able to repurchase and retire shares. So the fund traded at a huge discount to NAV. We bought a huge position in GBTC when it traded at a 30% discount and when Bitcoin had come down by a huge amount off of its highs. When Bitcoin came back, we profited when the dollar price of Bitcoin rose and when conversion from a closed-end trust to an open-ended ETF caused that discount to close. So one of the things people have talked about a lot over the recent few years, recent few months, recent year, has been the incredible increase in the dollar price of Bitcoin because of the way we structure this and took advantages of quirks in the closed-end fund or trust structure. Our returns on Bitcoin were 30% better than the returns that you see when people say we made, 5 times our money in Bitcoin, 6 times our money in Bitcoin. We did that plus 30%. And it was just a gigantic return. I still love Bitcoin, but I would not be buying GBTC right now. There are better ways to own Bitcoin than that particular ticker. If you want help with that, reach out at ir@deepknowledgeinvesting.com, or as Rob always tells you, just go to the Deep Knowledge Investing website, click the Ask Gary button, and we'll help you figure out the best way to own Bitcoin. And if you want to self custody, we'll send you the guide to how you can do that.
Yeah.
At any
Great.
rate, the whole point of all is if you want to know the next time we discover an asymmetrical trade like that, then subscribe and we'll be there for you.
Yeah, and I think that's the highlight to make. Gary and his team leaves no stone unturned in terms of understanding the market, finding strategic positions, advantageous positions, and regardless of what the market is doing, good, bad, indifferent, DKI prides itself on being able to make money in any economic environment. So definitely head over to our website, deepknowledgeinvesting.com, grab a subscription, and we look forward to having you as a part of the team. That concludes this week's version of the 5 things, the Doge wins issue. We've mentioned multiple times, head over to our website. Worst case, like, subscribe, leave a comment. Thumbs up, thumbs down. If it's thumbs down, we just ask that please let Gary know what you don't like about him or why you disagree with him one way or the other. Or it might be me too. Either which way. If you don't like the way I ask the question, something like that. We love any sort of feedback.